back on Morning Movers. Oracle set to report its latest quarterly results after the close today. Analysts are expecting earnings of $1.63 per share on revenue of just over $16 billion. Investors will look toward Oracle's capex and debt on its balance sheet for a measuring stick with regard to the AI trade. Shares of Oracle jumped over 35% after its last earnings report, but have since fallen 36% from those intraday highs that day. Time now for Options Corner. Joining us for a breakdown of the chart is Rick Ducat, lead market technician. All right, Rick, let's talk about it. It is still an outperformer year to date, but that does not tell the whole story here.
Yes, very true. And, just about on par with the XLK Tech ETF right now. But as you say, Oracle's debt is one of the most interesting examples of this race to adopt these new technology advances here. And the question is whether the revenue in the future will be enough to overcome its debt burden here. But you can see some of the other players in this cloud space, some real heavyweight names here. Google, the outperformer, obviously, of the group. Salesforce, kind of the underperformer here by far. Oracle mostly in the middle of the pack here. When we do look at our candle chart more closely for Oracle, downward sloping channel is what happened after we had our highs, 345.72 after earnings. We did retreat back to this level here near about 217. That was these old highs and subsequent lows. We had a bit of a foothold there for a moment, but then we broke downward. 189 is where things came back into focus. That was the low point after a gap up, as well as some notable highs in this area as well. Now we have made our way back above that 217 level. We have a short-term upward trend line in play here, but as you can see very obviously, earnings can really provide a major catalyst for change in a stock like this. Now we can see we are above our moving averages. They're clustering together right around here near 217, our 21, 5, and 251 day EMAs. We can also see RSI starting to improve here as we approach earnings, but still below that 50 midline. Finally, when we look at volume profile, we can see that our point of control, our heaviest trading area of all, comes in right around 234, so that'll be a notable upside area that the bulls would want to overtake. We also have another volume node here near about 220, so we're within that one right now. If we do start to move lower, volume picks up again here near about 180. Finally, if we were to look at our expected move here, December 19th, 12.1% expected move potentially. We can see everything kind of lines up here around that 220, 215 level. So an important foothold point there. Finally, 250 is that upper boundary that we could see by this expiration.
All right, thank you, Rick. That is the Duke of Data himself, Rick Ducat, with a look at that chart for Oracle. Now take us through an example trade. We've got Tom White, a senior options contributor and co-host of Fast Market. So Tom, what's the approach for an example trade for Oracle, given we've got earnings right in front of us?
Yeah, expect some volatility post these results. You've seen that pull back about 35% from those all-time highs that Rick noted on the chart there. So the bar's relatively low in this one, but there's a lot of minutia in this earnings report, I think, going into it. Option market pricing in just over a plus or minus 9% move in the stock, nearly $21 either way on this one. So I looked at strategy that takes advantage of the volatility levels between the different option series. If you're bullish, this would take advantage of that maybe one standard deviation move of over $20 either way. So looked at a bullish call diagonal, really short-term positioning. I went out to the December 19th monthly options here that expire in 9 days. Bought the slightly in the money 220 call. Stock looks like it's going to open up here about 223. So we'll buy the 220 call in the December 19th monthly option, sell against that in the near-term December 12th weekly options that expire in just 2 days. We're going to sell the 245 call. That aligns with that one standard deviation move. So a bullish $25 wide call diagonal to the upside, you're going to pay roughly only about $10.50 debit for that. So a lot less than the width of this call diagonal. And then that's because of that vol dispersion that I mentioned, where you're buying a lower implied volatility, selling a really elevated one in this week's weekly series. Paying 10.5 debit. Anything above about 225 is going to be potential profitability on this. You see here from the risk profile, apex of profitability right at or near that short strike around 245. So that's what you're aiming for. But because you're paying so much less than the width of this $25 wide bullish call diagonal. Anything above that 225 level, it's going to be profitability. So if you do see one of those outsized moves like we did last quarter where the stock actually ramped up, or when that news came out where they took on more debt, where you get that big sell-off. So this takes advantage of that move to the upside. Now, you're buying that lower implied volatility. You're buying about a 95% implied volatility, selling over 150% implied volatility. So this might be the way to look at it. If you're bearish, do a put diagonal, but this is the bullish example trade here in Oracle.
All right, thank you, Tom. Appreciate that example trade there for Oracle, which has earnings due after the close of trading today.